Hi, Matt Hale from Rising Tide here. This week I was fortunate enough to sit in on an economic update with one of the heads of investment at Macquarie Bank, Martin Lycos. The key areas he covered off were some detail regarding the worldwide economy, some risks they are still worried about, and then also some things regarding Australia specifically. Martin was quite adamant that the key risks associated with the next 3 to 6 months are two things. Firstly, what impact will any secondary and following flare-ups of the virus look like, as isolation and social distancing restrictions are removed? He continued to reiterate that this is primarily a health crisis, and without a vaccine, there is still a considerable amount of uncertainty. The secondary risk, which is still yet to play out and may take another 6 to 12 months to fully evolve, is the impact that coronavirus has on corporate earnings around the world. This is important for two reasons. Firstly, how much money do the corporates have to invest in strategy, technology, and people? And secondly, what sort of dividends are individuals going to get from the shares they own? A great local example recently is the National Australia Bank significantly reducing their forecast this week for earnings. Specifically related to Australia's financial circumstances, Martin was quite bullish. Basically, he said that coming into the pandemic, Australia had a net debt of approximately 22% of our gross domestic product. To compare that to an economy which is very similar in size, Japan had 7 times that amount of debt. Simply, that means that we went into this pandemic in excellent economic condition. And just like the people that have obligations right now and are still working, a low interest rate environment means that they can afford to pay the debt for a little while longer. Finally, given how cheap the debt is, that will also mean that they can continue to contribute and stimulate the economy throughout the next few months. Martin also believes that at the back of this coronavirus pandemic, serious tax reform must come. And that doesn't necessarily just mean more taxes for all of us. Primarily, it means that they need to have a broader tax base so they get more taxes from more people, so that if the economy slows down, they've still got good income coming in. An example during the week has been a discussion around stamp duty changing from just new purchases to existing households. And while that might seem large, please remember that any significant tax reform will likely affect everyone, but will also take some time to come to fruition. Finally, for Australia, Martin believes that there may be some areas of production where we can use this time to become more independent again. He used the example of oil production, where up until this crisis occurred, when oil was quite expensive, Australia was facing some serious dramas in this space. The price and the lack of ability to obtain enough oil was crucifying for Australia. This will hopefully change in the long term, given there's more flexibility in price and more opportunity to produce now. Some other things I noted during the update is that the recovery period is expected to be quite short, due primarily to the demand which has been built up while we have all been locked away. Saying that, if those secondary flare-ups I mentioned earlier cause enormous damage, that will definitely slow things down. From an investor perspective, Martin stressed the need to maintain and keep exposure to overseas assets, particularly in the US, as much like Australia, they came into the crisis in really good financial condition. Finally, from an investment perspective, those that hold companies that produce iron ore are likely to continue to see great profits. The main reason being is that the only other iron ore producer in the world, Brazil, is facing some serious issues with relation to COVID-19 over the next 6 to 12 months, and therefore that puts Australia in the box seat to be able to produce most of the iron ore at a better price. Martin also confirmed that it's likely gold prices won't increase in the short to medium term, as two of the factors that relate to gold price are the US dollar being low and high inflation. With both of those not being the case right now, it's a really good chance that gold will stay where it is or very close to where it is for the medium term. If you have any questions relating to your investment portfolio, please feel free to touch base via the website and we'll do our best to help. Cheers.